Back with closing trades right here on ET Now. Let's try and deconstruct what the market has been like from last Diwali to now and what it's going to be like as we step into somewhat 2082. We've got Nimesh Chandan, CIO at Bajaj Finserv Asset Management, joining in on the show right now. Nimesh, hi. Thanks for making it to the studios, and festival greetings firstly to you and your entire team.
Pleasure to be here, and festive greetings to you and your team.
Okay. Is it really going to be as sparkly and as bright a Diwali as one anticipates? Because last year has been nothing really.
I think last year was a bit tough, and we saw multiple issues in terms of geopolitics coming up, multiple tweets disturbing us overnight. So I think this year looks like we are set for a strong up move. I think markets are like a coiled spring, and we'll go through this process of de-verification, as I call it, that there were so many worries which were putting pressure on valuations. And now one by one, we are getting these solved. So even if you don't see much change in the Nifty estimates in terms of earnings, you will see a sharp increase in valuation. So I think we are set for that kind of a move in terms of re-rating upwards or coming back to our high valuations.
But isn't the critical thing for the earnings to come back? When do you foresee that happen?
So surprisingly, some of the major events that we were worried about have hardly had any impact on Nifty earnings. So if you see the Trump tariff issues, 0.3 to 0.5% of GDP was getting impacted. It is impacted right now because of the penalties. And about 2% of the Nifty 500 or NSE 500 profits were getting affected. There was not much change. In fact, government has given a stimulus which is equal to 2% of the GDP. And that will probably see the second half, consumption doing well and also capex coming back. So Nifty earnings were not affected. But it's typical nature of the crowd behavior that when you are uncertain and fearful, if you don't change your EPS estimates or PAT estimates, you actually reduce your multiple just to accommodate some of the worries that you see on the horizon. So if these worries get cleared, automatically you see the converse of that happening, where you will see the re-rating upward without changing much the EPS number.
And Nimesh, of course, so therefore the Nifty EPS growth over the last 12 months has been single digit. And that is, if I can call it, a possible concern. Do you expect that to likely go up? Because, of course, top line growth may be supportive to a certain extent, but that is also yet to be fully felt where the numbers are concerned. When does that happen, if that is so?
So I think we've been through the worst. So I would say if last year the FY25 Nifty earnings grew at about 6.5 or 6.8%, that is Nifty at its worst. It saw so many issues last year in terms of we had a very slow GDP growth in the first half. Yes. We saw some liquidity issues, rupee having a struggle in the third quarter of last year. So we saw tight liquidity, we saw tight business conditions and slow growth. And yet Nifty, because of its very diverse sector base that is contributing to earnings, we saw 6.8. This year we are likely to see just move towards a high double digit, just move towards a double digit. So you will see about 9% or so kind of earnings growth. Next year you move into, say, 12 to 13%, although the estimates are about 15%, you see about 12, 13% can be done. Look at the trajectory, 6.8, 9, 12 to 14. You are actually seeing a strong recovery. And India's strength has been this diverse earning base, so many sectors contributing. Yeah, there'll be years where probably IT may not do so well, there'll be years where banking may not do so well. But this stability and steady earnings growth actually what gets Nifty its high multiple in the market. We are not so commodity driven or we are not so volatile. I think when people recognize this, that India is one country where you can stretch this 6.5% GDP growth rate till 2030, which is very rare to see in other countries. And if earnings are going at, say, 10 to 12% even for the next 5 years, you have a very steady growth in Nifty, just even if the valuations don't change.
Let me take a cue from that. Which sectors, therefore, do you believe will benefit the most and will, in fact, benefit upfront from all of the measures that have been taken? The lowest hanging fruit, if I can call it.
Consumption is a very easy pick here.
Okay.
Because we have just seen a pickup in consumption. Last 2 years, most of the market was focused on the capex side, mainly on, say, defense side or certain specialized manufacturing side or so. We will see now attention going towards consumption. These are brilliant quality companies. They deserve a higher valuation because they are branded businesses, they have more steady growth, they have cash flows. Many of them are at very good dividend yields. Last 2 years, these guys have been going through a slowdown. Now you will see an earnings upgrade as well as a valuation upgrade. And the India consumption story is a 5 to 10 year story. It is not a short-term story. So you will see this large pool of subsectors starting to do well, whether it is consumer discretionary, staples, quick commerce, digital consumption companies, travel, QSRs, you name it. So there is huge amount of scope for many of them to grow. You have to just pick up which are the right companies, which have the right moats and the right cash flows and the right valuation.
But where do you see the profit pool getting created?
So much of the consumption story, if I put it, is about unorganized to organized, and within organized, premiumization. So if you take these two trends, companies and brands that are able to give their customers an option to move from unorganized to their brands and then scale them up within their brands. Think of the auto sector, right? You saw a move from two-wheelers to four-wheelers. Four-wheelers, now SUVs are a large part of their allocation or of the consumption. Look at companies like, I'm just using a name, Mahindra and Mahindra, which has a huge, beautiful portfolio of SUVs, how it has done, despite when overall consumption was going a little slow. There are many companies within FMCG, QSRs or so, where you're moving from unorganized to organized. And that trend is irreversible. So people aspire to have brands, aspire to move up and premiumize. So you have to pick up these companies which allow or have a portfolio which allows you to move up there. We are positive on some of the high growth sectors within consumption, like consumer discretionary. Home improvements is coming back in a big way. You saw some of the recent listings. People are seeing very strong move in white goods, and that's why you're seeing premiums coming to these companies which are also getting listed. So there is a whole bunch to play. Yeah, we look at some of these mega trends within consumption, that unorganized to organized, so where people are consuming more, consuming better, consuming easier through financing, digital commerce, those areas which we find as high growth potential areas, and we are bullish on those.
But have all of these pockets got valuation comfort? Because every time we speak consumption and we speak with anyone who seems to be a sort of a pessimist in investing in consumption, always the reason that comes up is some of the valuations are extremely elevated. Do you find that there are currently pockets of value which may not be as elevated, which may be reasonably priced, and yet provide that margin of comfort in terms of making an investment at this point?
So because last few years I'm seeing the crowd becoming very short term, there is a very strong recency bias in the crowd. So right now, anybody who you speak to about consumption will first ask, is this company a GST cut beneficiary or it is not seeing a benefit of GST cut? Now, that is a very narrow way of looking at it. And frankly, some of the, say, auto was an obvious gainer in GST cuts, and you saw auto stocks just move up very swiftly. And they were under-owned. The full year growth for passenger vehicles was not much. It was very low single digit. Now it's been revised upward. So you saw a very sharp move in auto first because of the GST benefit. Now, if you take into account the total impact, the wealth effect in households because of gold, the income effect because of the income tax rates that are cut, there is another trigger which is coming for urban consumption, which is the 8th pay commission changes. Rural is continuously doing well. So I would say, because people have this recency bias, there are certain sectors, certain stocks have become expensive, and we are also a bit, because they are touching the bull case scenario for us, we are also not so excited about those. But if you dive down, there are within large caps, mid caps, small caps, there are many spaces. And you can play some ancillary plays also, right? NBFCs, which are, say, financing consumption, autos or so, they have important. Today we are seeing insurance companies that are benefiting from auto sales or consumption increasing. Those are starting to do well. So if you actually unpack this theme and not look at consumption as one sector, but unpack it as a theme or a mega trend, then there are many, many areas you can go for.
And what about consumer tech?
Absolutely. So these are companies which are increasing their market share and they see visibility and scalability of growth for many years to come. Now, again, they went through one hype curve when they got listed at very high levels and then went through a trough because there were disappointments, and now they are actually coming back. And here the men are separating from the boys. Companies that have a strong business model are able to monetize these trends, which means your customer is allowing you to make some profit or EBITDA from these businesses. And for many of them, the investment phase is getting over. It's now time to reap the returns. For many of those, you will find that the crowd is ready to pay high for that scalability, for that growth. So those also, we are very positive on these digital tech companies or some of the new age companies that are there. And so whether it is, I'm not naming, but there are many of them, like quick commerce companies and many of them which have been recently listed. Those are positive companies that we play for. And consumption has its impact on the economy. Consumption will ultimately lead to private capex coming up because you will see capacity utilizations moving up.
Yeah, you saw that with Maruti.
Businesses looking to invest more on that.
True. So that's of course the consumption end. But what about the traditional businesses? What about commodities? What about IT?
So we have a strong contrarian buy call on commodities, which are metals and
Which is
real
done well.
estate. So those two, we have a strong buy because we believe that these companies are undervalued. They are trading at replacement cost or below their NAVs or whatever metrics that you use for measuring them. And we are seeing an upturn globally in emerging markets. You will now see last 10 years, emerging markets have not done so well. Now, because of less pressure from the dollar side and interest rates being low in the US or being cut in the US, you are seeing change in emerging markets. So those countries are doing counter-cyclical investments to boost their own domestic growth. That typically leads to better consumption in terms of metals, demand for metals going up. And over the years, the cost of mining, cost of sustainably mining is going up. So many of these metal stocks you will see, and silver is just a glimpse of it. It is a combination of precious metal and industrial usage. But you will see steel, copper, aluminium, zinc, all now showing some kind of an uptrend. It's difficult to predict metal prices very accurately, but you can definitely say when they are cheap, and you can take a bet on those. And many of these metal companies, see, last 10 years, these metal companies have also cleaned their balance sheet. Many of them are dividend yield plays.
Yeah.
They are not doing capex at the wrong time and then getting stuck with huge debt on the balance sheet. They've changed that also. Real estate also, if you see, the balance sheets have been cleaned. And we are seeing a good pickup in Diwali. There are many launches planned for Diwali. And real estate, when it grows, it again has a multiplier effect on the economy. You have, it is a very labor-intensive sector. Cement, steel, white goods, tiles, faucets, wires and cables, paints, everything starts getting improvement. So you will see in the ecosystem, the home improvement ecosystem also starting to do well after many years in this. And because once these companies used to be trading at very high multiples because of their brands and sustainable growth, now they are available cheap. And that's where we are bullish that some of these ancillary plays also become very good attractive opportunities to pick up. IT, we are a bit underweight. So it's more of a call on macros that we have taken, that we are looking at some slowdown in the US and high inflation there. So they are problems for the economy. They will probably see more political issues because of the shutdown and negotiations on that. So we are a bit underweight on IT, but domestic sectors, very, very bullish.
Okay. Nimesh. Great to have you in the studios. Thanks
Pleasure.
for your insight and happy Diwali once again.
Happy Diwali.
Okay, let's just revisit where the market has settled in at. Not bad, 25,420. It's Nestle, Bajaj Finance, Asian Paints, L&T. Interesting bunch of movers out there. And of course, metals as well are holding out. Good breath as well for the market. We'll address all of that when we return.